today we're going to be talking about alternatives to venture capital funding. Hey, Lisa. Ooh, fun group, guys. So what I'm going to be going through is a overview of some of the different alternatives in the first bit, and then really I'd like to be able to allow you all to drive the session with your own questions. So I've got as many of you probably know, more content than we ever have time, but for the next hour, we'll try and see how much we can get through in regards to the different types of approaches, structures, and alternative case studies. So let's start out, as I always like to do before we talk about alternatives, to have a quick session from everyone. You can unmute yourself or you can put it in the chat. Why do we need alternatives? What about venture capital is not working for impact organizations on the continent and just in general? I'd love to hear from all of you.
Good afternoon.
Good afternoon.
Among the few people that I know who contemplated VC capital, I think there's just an intense fear that you're going to wake up and find the company is not yours.
Yeah. So Frank, completely just losing your company. So putting your heart and soul into it, and then selling it to investors and essentially losing control. Absolutely, Lisa. Yeah, timing often isn't a match in the sense of it takes a long time to raise, and oftentimes that's not the capital that's needed. Then what else? What else doesn't work?
It's not patient enough.
Great.
Capital.
Say more about that.
So basically, there are some early growth companies that fit a VC growth expectation and can maybe facilitate an exit within 3 years. But then we're missing out on a lot of potentially very impactful and financially viable deal flow that needs a much longer investment horizon and also needs investment instruments that allow for a longer investment horizon to still make sense, to be viable. Yep. So also a lot of the different instruments, quasi-equity and so on.
Exactly. Yeah, we need more patience. Absolutely. Hope.
Thanks, Annie. Another reason why it doesn't work most of the time is that our businesses sometimes are not as unique as the VC might want. So VCs are mainly looking for like unicorns, the next Facebook, and perhaps the invention that we have right now is not up to par. So that's a reason.
Completely hope. And I think a few other people have said that in the chat as well, 100%, in unicorns. And Frank, I think you've said this really beautifully, actually, that the VC cares about their exit, even if it comes at sacrificing opportunities. So it is very much about that. So hope about that, like looking for the unicorn and then growing and exiting that unicorn, or if the company is not becoming a unicorn, then potentially getting out or trying to find ways to get out. And it doesn't always work for within local markets, smaller markets, right? So one of the things that we know about equity is that it requires exponential growth. It can be somewhat patient, but not necessarily always patient enough. It can be hands-on because the investors are incentivized with the entrepreneurs, but it also comes at a significant cost in that you can lose control. You can oftentimes have investors that are able to make decisions for you. And I think one of the biggest things is that it's extremely exclusionary because of this need for unicorns. So there are a lot of amazing organizations, I'm sure many of you in the room, that have incredible organizations that you founded that do not fit the venture capital mold. And that's okay, right? Just because you're not trying to be the next Facebook. The question is how many more Facebooks do we want or need? So my name is Ani Patton-Power, and I have wrestled with this question for many years now, and have been working with early stage entrepreneurs for about 15 years, starting in kind of more mainstream been investing and then kind of into impact investing for the last 12 years. And for me, this question of how we invest has been as important as what we invest in. And part of this is that one of the things in impact investing that we were doing at the very beginning was to co-opt traditional investment structures like venture capital and private equity and add an impact lens, which is still a lot of what we do within the impact space. But as we've all just said, that doesn't necessarily meet the need of most impact organizations. And then we also have to recognize that traditional debt is also not a fit for most organizations. So this space in between equity and debt, and also being quite creative on the grant side, is a space that we need to play in more. So I'm going to be talking today about these spaces, particularly the in-between debt and equity and some of the options. And I would encourage you, so all of the graphics that I'm using in the cases all come from my book, Adventure Finance, which essentially is it's not a textbook, although I am an academic and teach at many universities, but it is a complete guide to how to think about these alternative structures. And it's written in a very readable way, I would like to say. But so let me give you a little bit of an overview. So this is kind of when we think about equity, debt, and then grants. And this is, you can see a little bit of an overview of the book as well. So you've got traditional equity investing, which we often do either in an equity purchase, which is shares, or in a type of structure that we call a SAFE or a KISS, so a simple agreement for future equity, which is a very simple equity investment tool that allows you to essentially purchase equity in a future round and can help you to put off the valuation. You also have convertible notes that are used quite regularly that are actually debt, but these then convert into equity at a later round. On the debt side, we have unsecured loans as well as secured loans, which can be useful for organizations, but often very difficult to access, which is one of the reasons that organizations look for things that look more like equity. And then as we start to get a little bit more creative, we have options like venture debt and mezzanine debt that we're going to speak through today, as well as factoring and supply chain financing, which are options that you may not even know exist, which allow you to use your customer contracts to be able to access funding. We're then going to talk about something called redeemable equity, which is essentially an equity agreement, but with the option for the founder to repurchase that equity. And something called convertible revenue-based financing, which is essentially like a convertible note, but is paid off over time as opposed to necessarily converting into equity. And then also revenue-based financing, which is can be more debt-like in that it allows you to borrow based off of your historic revenue and then repay based off of future revenue. But don't worry, we're going to go through all of these different examples, and I'm going to talk through some cases and have you guys answer some questions. We likely will not have a chance to talk about the rest of this today, although if you do have questions, we can dive into it. But this just gives you an overview of what else is in the book, looking at a variety of alternatives in the grant space, as well as impact-linked financing, crowdfunding, social impact bonds, other types of sometimes more complex, but can be quite useful forms of financing for impact organizations, nonprofit or for-profit. Okay, but before we start talking about structures, how do you know as an entrepreneur what type of funding you need? For me, in the book, what I developed was a founder evaluation that essentially has 4 components. There's 3 on this screen and 1 I'll do on the next screen. Who are you? How mission-driven are you? What are your funding needs? And then what type of funder do you actually want? So just looking through some of these questions, thinking about how your company is registered, whether you're a for-profit or a nonprofit, has implications on the type of funding that you can access. really thinking through your internal financing. This is something we often overlook, which is how do you make money? How are you going to make money? Who are your customers? The Silicon Valley approach of, get a product out and grow as quickly as possible, but don't worry about revenue, will not necessarily work for most organizations in the impact space, or really organizations on the continent that can't access that type of risk capital. You also have to understand what stage company you are at. So are you an early stage company? Are you a growth company? Are you at the concept stage, i.e. do you have an idea, but not necessarily any sort of revenue? And what your growth projections are. So your growth projections do not need to be a hockey stick, which is what we often talk about in the VC world, but understanding realistically what your growth projections are. And this evaluation, which I'm going over relatively quickly today, is a couple of chapters in the book, which really allows you to dig into these questions to be able to do this type of evaluation. Then you have to ask how mission-driven you are. How embedded is mission in your company? And do you have an impact track record? Because both of these questions are important to think about the types of funders and the types of funding that potentially you are able to access. And then on your funding needs, really understanding how much funding you need. This is something that most entrepreneurs do not do well. So figuring out what you need to get to your next stage, how long you need that funding for, what you need to spend it on. If you have any assets for collateral, i.e. do you have anything that you can put up to be able to secure your funding against? And we'll talk about some alternative forms of collateral in just a moment. You also need to look at how do you want to pay this funding back. So some entrepreneurs that are taking traditional equity financing are looking at, in the long run, i.e. 5 or 7 years from now, having an exit or a liquidity event, we call it. So they have an exit of some kind and their investors will get paid back. Some of the alternatives that we're going to talk about require you to pay it back over time from your revenue or by taking out additional debt. You also have to look at what your ownership expectations are in the short and the medium term and the long term. More and more entrepreneurs are wanting to own their businesses in the long term or have some sort of community ownership or employee ownership. And understanding how that potentially can affect the types of funding that you want to be able to access is important. You're going to need to think about what kind of funding you need in the future and how involved you want your funders to be as well. Before I move on, I'd love to take a few questions on this founder evaluation. Questions? Okay, I'll keep going, but I do like questions. So, oh yes, Joram, go ahead. Am I saying that correctly?
Yeah, thank you. Can you hear me?
Yes.
Yeah, thanks. So maybe I've missed it, but I was thinking about, I work with startups, and one of the key things I've realized that a lot of early stage startups struggle to have the right team in place. I was wondering if that is something you think about while evaluating.
Oh, absolutely. Having the right team is a hugely important piece of this. So this is, really trying to figure out, so as opposed to Joram evaluating whether or not you want to invest in a company, which is, so team for me, when I'm looking at an investment in a company, is the first place that I look at. This evaluation for me is more for the founder themselves to understand the type of funding. So this would be something that if you work with startups, that I would say making sure that they have the answers to all these questions is the way to go about this. Evaluating them for an investment would be for me a very different set of questions, actually. Does that make sense?
Yeah, thank you.
Cool. Great question. Yes. Oh, sorry. But oops. Whoa. Things are going. All right. Yes. Let's see. Who else do we have up here? All right, Rebecca. Hi, Rebecca.
Great. Hi. Thanks. This sounds like it's going to be a super interesting session. A quick question, just on the evaluation. The questions look great. Have you mapped them to different types of capital? Like, is this actually like a dynamic kind of questionnaire? And if so, can that be accessed? Or is it just more something that you recommend entrepreneurs work through with support?
So Rebecca, it's a really good question, and it's kind of a question I can half answer. So you'll see I have a short kind of key that's in the book, and then I'm working on with quite a few other people trying to find a way to make it some sort of online integrated tool. But where it is right now is that I've developed a couple of sets of decision trees that I also am teaching when I teach the information. So it's like essentially it's in progress, but I've got a cheat sheet that I'm going to show you in a moment that is the starting point of it.
Great, good, thanks.
So what I'm trying to do, Rebecca, also is with some of these other partners, use some of this mapping to be able to create kind of more master decision trees. It's quite complex, but I think we're going to get there. So eventually, and there's a couple of interesting organizations that I'm working with it on. So I'm hoping to be able to have something that's kind of online, interactive at some point.
No, that would be amazing.
I think so.
Thank you.
I think so too. It would be really useful. And you'll see in the book, in the last couple of chapters of the book, there's a bit of a kind of mapping exercise there too, but it's still all can be quite complex. And then what type of funders, right? For me, understanding the different types of funders out there, the different types of resources that they provide, the level of risk that they're comfortable with, the type of return that they require, and who are their stakeholders. So what I would suggest here is that, there's a few different steps, right? Really as an entrepreneur, and I'm focusing this masterclass on entrepreneurs. I totally understand if people are investors, so you just have to, in this point, just kind of thinking as the entrepreneurs, and feel free to ask questions from either side. But for me, this is very much about entrepreneurs understanding their options. And so really as entrepreneurs, you need to understand who you are, as well as how important your mission is, what type of funding, what your funding needs are to be able to understand the type of funding, and also the vast amount of funders, different types of funders, to be able to understand. So Olivia, IP absolutely can be an asset. So we're going to think about a couple of different alternatives for collateral, but IP, yes, is something that you can borrow against. And as far as the slides go, these are all taken directly from the book, and they also actually all are available. All these different elements are available on the book's website, which is just adventure.finance. I'll just put it in the chat here. So basically everything that I try and make everything that I can do open source. So there you go. All right, so Rebecca, here's the quick cheat sheet that I've created, and I've got a couple of other decision trees that are simple as well, that we won't, I don't know if we'll have time to go through today, but that I can definitely share. So from the mission or the impact side, if you have mission embedded in your governing documents, i.e. if you are a social enterprise that is governed by your social mission, or if you are a nonprofit, or if you have a verifiable social or environmental track record, if you've been collecting data that can be verified, then you can consider grants, recoverable grants, which we will talk about, which are repayable grants, forgivable loans, potentially convertible grants, or even impact-linked financing, which we'll go over as well. If you have physical assets and a credit history, and physical assets can include IP sometimes, but if you have essentially physical assets and a credit history, or you have a guarantee, which is a funder that has stepped in to guarantee your repayment, then you can look at secured debt from, for instance, a bank. Now, I know most entrepreneurs do not have that. That's why we kind of skip to the next section pretty quickly. If you have invoices or purchase orders and or a history of fulfilling orders, you can consider something called factoring or supply chain financing. And we're going to talk about exactly what that is in just a moment. If you have recurring or repeatable revenue, you can consider something like revenue-based financing, which we'll also talk about. If you have venture capital funding, you can think about venture debt. And if you are planning to essentially sell your company, merge with another company, or create a public listing, I don't think you're probably in the right class, because you can just do traditional equity there. But if you're planning to repay from your own cash, then thinking about things like some sort of structured exit will be potentially useful. And we're going to go through all of these terms right now. So starting with revenue-based financing. Revenue-based financing is a type of finance that essentially allows you to borrow based off of your historical revenues and repay based off of your future revenues. There are a larger set of funders globally that are offering these, and there's a whole range of different types of revenue-based finance. In fact, you may hear the term revenue-based finance being used to describe any number of different alternative financing options. What I'm kind of speaking about here is companies that are looking at 2, 3, 4, 5 months of historical revenue, and then allowing companies to repay a relatively short-term loan, in essence, based off of that. So the example here is a company in India called GetVantage, which lent money to Seymour, which runs these bike rentals. They actually do the software that runs the bike rentals for different municipalities and corporates. And they needed a short-term advance, working capital, which I know many of you struggle with as entrepreneurs. So what they do is they go to GetVantage and they say, here's our revenue for the past 3 months. GetVantage looks at that and says, in this case, they have clients that are paying, they have repeatable revenue, recurring revenue. They have clients that are paying them every month, that have signed up essentially for a subscription, that are clients over time. And so GetVantage says, yes, we think that this revenue essentially is collateral, is something good we can lend against. So they will lend that money to Seymour. Seymour will take out that loan and then will repay that loan as a percentage of their revenue. So the repayments are completely flexible. And then once Seymour has paid off the entire amount, then they've repaid the loan. One of the things that we've seen during COVID, funders that have done this is that they've been able to be very flexible because the entrepreneurs that are not, having revenue come in are not having to pay their loan payments, or having to pay reduced loan payments. And so multiple funders actually that had portfolios, revenue-based portfolios during COVID actually have seen repayment now pick up again, but they didn't see defaults because technically the companies weren't in default. So is it Wanyohi? Wanyohi, is that right? Can you help me pronounce that? Let's go with that. I have a good question in the chat here that has tended not to be popular with. Oh, go ahead.
Sorry, I was
yes,
muted. It's Wanjohi.
Wanjohi. Okay, wonderful.
Yes.
All right, Wanjohi, you've got a good question here about it's tended not to be popular with entrepreneurs. So I think what I've seen, Wanjohi, is that this I'm going to be talking about, we'll see how much time we have, but I'm going to be talking about 7 or 8 different approaches today. And they're all very specific for different types of, both different types of entrepreneurs, as well as different types of capital needs. And so what I found is that revenue-based financing is incredibly interesting for organizations that would otherwise have to do equity financing for short-term working capital needs. And so it's expensive. If you can get a bank loan, go get a bank loan. But for most of the organizations that I'm seeing, particularly technology, small startups with technology that don't have assets, that need like quick, 4, 5, 8 months, 12 months, 2 years of working capital, that this option is a really good one for them. And so I'm actually finding what I've seen is that the revenue-based financiers that I have worked with struggle. They struggle themselves to get enough capital to be able to lend out. They have too much demand.
Okay, thank you. Good answer.
Yeah, but I'm interested to hear what have you used it yourself?
No, I've interacted with the entrepreneurs who either used it or evaluated term sheets, but they've had to walk away from that. Also from the supply side of capital, I know some debt funds, 1 or 2 debt funds based locally in East Africa, and they've, with time, walked away from that.
Yeah, so it's one of these things that has to be applied correctly. And so I've also seen term sheets. This is done by debtors that are very, very expensive that don't necessarily make sense for the entrepreneur. And we'll talk. I think the ones that it sounds like you're talking about are more, and I have a different category. It's called convertible revenue based, just because it looks more like a convertible note. I think the thing to say for any of these is that they can be applied the pricing can really affect whether or not it's attractive.
Yeah,
so
the key is to make sure that you it doesn't take the top line. You make sure that you leave some leg room for the company to be able to be, it's typical working capital needs, whether it's ops or salaries and everything. But
absolutely. And so that's actually another point when Johi, that's really important here, that I make a few different times in the book, is that this type of financing only works for high margin businesses. So this does not necessarily work for low margin businesses. Hold on, sorry, I'll get that. There we go. This doesn't work for low margin businesses. So if you are an organization that does not have the ability to pay this back, this is not the right type of funding. So that's where the organizations either need to have, as you said, some sort of bottom line, so i.e. it's some sort of dividend as opposed to a debt payment. And we'll talk a little bit more about the convertible revenue-based financing. Any other questions on revenue-based finance? No? All right, so redeemable equity is another option that I think, so right now redeemable equity is one of those structures that really doesn't, that is still, I would say, very, very nascent. I personally am actually doing quite a bit of work around redeemable equity. Just we really have to understand some of the tax implications better for investors, not for entrepreneurs. But in essence, in the case study that I have in the book is an organization called Fledge, which invested in a company called MyTurn. Essentially, they purchased shares in MyTurn. So this looked like a traditional equity transaction. But MyTurn had the option to buy back the shares from Fledge at a later point in time. And how this can work is either in a lump sum in the future, where they are repurchased as part of fair market value, or they can be purchased as a percentage of revenue. And this is where sometimes people call this revenue-based financing as well. It gets very confusing. Or there can be some sort of combination between the two. So there's an option to either say, in the future, you as the entrepreneur can rebuy these shares in 7 years, or you can rebuy these shares over time in this schedule, or some sort of combination. And what I'm seeing is that more funders are interested in allowing some portion of the shares to be redeemed. So not necessarily all of the shares to be redeemed, but this then allows for them to be able to see some cash back over time, and for the entrepreneur to be able to essentially repurchase shares that are oftentimes very, very early. So very, very inexpensive shares. So sometimes, angel investors, seed investors that then can see an exit, and the entrepreneur can then repurchase that ownership. So here's for numbers how it could work. So for instance, in this case, Fledge put $20,000 into MyTurn plus 2 months of training at the accelerator in exchange for 50 shares or 6% ownership in the company. So over the first 7 years, MyTurn redeemed 25 of those shares quarterly using 3% of their revenue. And the redemption price of the shares was 3 times the original purchase price. So the original purchase price was $400 a share. So they bought back these shares at $1,200 a share over 7 years. And then at the end of 7 years, they were able to repurchase those final 25 shares at a price that was agreed upon between the two parties. So in the end, Fledge may end up making $60 or $80 or $100,000. And then MyTurn, the entrepreneur that founded MyTurn, even though they had sold 6% ownership in the company, were able to repurchase that. And in this case, MyTurn did not raise additional capital. So they were very interested in being able to access some initial capital as well as some of this training from the accelerator, but they didn't want to be put on a venture capital path. They didn't want to have to, in the future, continue to raise and raise and raise and raise. So this allowed them to be able to have a clear schedule around how they would repurchase the shares, and then how they would essentially create an exit for Fledge and be able to continue owning the company. What I'm seeing from a redeemable equity perspective is an incredible amount of interest by both entrepreneurs as well as funders, even if it's partial redemption. So not to get too technical, but in essence, it's kind of like a put. So the ability to essentially have the funder say to the founder, here, buy back these shares, or the founder say to the funder, I would like to repurchase these shares, to be able to either own them myself as the founder, or the other way that I've seen it done, and I think is an incredible opportunity, is actually taking those shares, repurchasing them on behalf of the company, but putting them into an employee ownership or even community ownership bucket, so that then the company can use the transition, the repurchase of these investor shares, to be able to make the ownership of the company more broad-based. And this is something that multiple funders, including the Candide Group in the US and a few others, Purpose Capital, are also using to be able to create a transition towards employee ownership using this type of redeemable equity. Questions on redeemable equity? No. Keep going, but feel free to ask questions anytime. Another option to think about if you're looking for traditional debt financing is finding a guarantor. So in the book, I go through the Riders for Health case study that uses a Skoll Foundation as a guarantor. And this allows them to access debt capital, which then led them to being able to access commercial debt capital without a guarantor later on. Yeah, Lisa, go ahead.
Yeah, sorry, I didn't get to the unmute button in time.
That's fine.
Just going back to that last example, where are the pitfalls in this? Where did they see challenges with either the structuring or actually completing the purchases over time? Or in some cases, they probably haven't finished everything at this point, of course. But
yeah,
some of the machine.
Yeah, it's one of those that it's like, so the reason that this example is in the book, it was one of the kind of few that I could find that had done the, full 8 years, and we could like reflect on it just because it's a relatively new instrument. So Lisa, there's a few different things that have happened. So the entrepreneurs have either, in some cases, the entrepreneurs have actually, instead of rebuying the shares, have actually ended up kind of continuing to raise funding and then even being sold, and then there's distributions to the funder. What's interesting? I mean, I expected to be able, granted I didn't have a huge set of cases in redeemable equity. I expected to find more examples of there being issues with repurchasing, and I really didn't. I think that when it's not applied a lot to be able to say that that's a conclusive data set, but, in the entrepreneurs that I spoke to, that this was part of their contract, it was often very early stage. And so the numbers that you're talking about later on, even if it's at a 3 or 4 times multiple for the entrepreneur, are tens or hundreds of thousands as opposed to millions. And so if you've created a cash flow positive company that is, that has the ability to repurchase, then it's, it's just seen as, something that is, you're paying your investor off, you're repurchasing these shares, you have ownership in your company. And so I didn't see a lot of friction points. Now, that being said, a lot of these are new. So a lot of them are still in the kind of like grace period before these are done. What I can say, having used this whole structure myself twice, is that we have not yet gotten any repayments on them, essentially any repurchases. But the entrepreneur is, has that option out there, and their dividends. So the way this is structured is a dividend, so it can't force the company into bankruptcy. So it's still a very risky capital for the funder. You don't have a lot of recourse. You can't say, you must, now or else. I mean, you can, but it just is not, you're not in the super strong position. And so it's very much still about working together with the entrepreneur to get them to the point where, they can issue essentially the dividends to repay. Where I have seen friction, Lisa, is in additional raises in the future, where the funders have looked at these structures and been like, what is going on here? And so have asked the entrepreneurs to essentially convert them all into kind of traditional equity, or there has been, that's where I've seen the essentially the friction.
Excellent. Thank you so much. Those are lots of great points.
Hi, Charlotte. It's great to see you as well. So Charlotte, how I've seen this being applied is kind of traditional equity time horizons, because right now, which is the topic of my next book that I'm currently writing, traditional fund structures are dictating kind of often when entrepreneurs need to repurchase the shares. So if it's a traditional LPGP fund, then the time horizon looks pretty similar. If it's angel investors, then it can be a bit longer. And because what's interesting is that if there is a bit of liquidity that's happening, i.e. if these entrepreneurs are paying off some of this over time, then the angel investors have cash to reinvest, which is kind of what they're looking for. So the angel investors that are doing this, including myself, have a longer time horizon for this. Whereas if it's in a traditional fund, then they're looking for kind of the traditional 7 years to exit. Although, what is multiple funds that have done this, that have started to see some of these distributions, their LPs have been very happy, right? Because suddenly they're seeing distributions in year 5, year 6, year 7 that they're not used to seeing. And so I do think that this can definitely work in a traditional fund structure with a traditional timing. And it may even be something, I think it's something that works really well with non-traditional fund structures, including holdcos, permanent capital vehicles, and the like. Shira, yeah, I really do think that redeemable equity could be a possibility for business incubators. And I have seen multiple incubators essentially, do the equity investment as part of their sustainability from their business model, but not see any cash for many, many, many years. And I think that applying this type of redeemable equity, where they could start to get payments in a much shorter time frame, as opposed to when the massive liquidity event happens, could be a very interesting way to apply it. Yes, Emmanuel. Yes, this is Looney Lives. Kanini, great to see you. So what I found that was quite interesting around the fair value on redeemable equity, and I'm very happy to spend, I think redeemable equity is one of the most interesting instruments out there, so happy to spend lots of time on it. So what I found is that it really hasn't been super scientific how people have done fair value. So Looney, for instance, has a conversation with the entrepreneurs about how much they think their company is worth, and then they come up with a number. Others have put in their clauses that essentially 2 independent evaluators that would then be able to value the company. And then other people have just had a multiple. So, it's going to be, so for instance, one of the structures that, and the ways to do it that I've seen that I think actually makes a lot of sense is allowing, somewhere between 50 and 70% of the shares to be redeemed at like a 4 times multiple, which then leaves some outstanding. So somewhere between maybe a 3 and a 4 times multiple. Because if you're looking at that, and sorry to get very technical, everyone, but if you're looking at that over an IRR, so over an internal rate of return, over 7, 8, 9 years, you're looking at a pretty good return. And then what they're doing, Kanini, is actually leaving that kind of 20 or 30% of the shares outstanding in case at some point there is a big liquidity event, and not even necessarily looking for that amount to be redeemed. So there's no fair market value discussion. But the 3 different cases that I talked to, well, Looney's done this a bunch of times, but then other funders that have done this, that have had a fair market value assessment, it was actually pretty simple. Because they went out, they had an independent evaluator, and or they just agreed internally. And it was because the company was these companies are relatively stable. So they're not J-curve companies. They're companies that are growing, but are cash flow positive. And so it's actually a lot simpler than I thought it would be. That was one of my biggest questions. People kind of said, well, we had a conversation, we looked at some comparables, we agreed on what made sense for both of us. And then, we paid them out. I was relatively taken aback at how simple and how nonchalant the case is. Now, again, I don't have hundreds of cases that I'm pulling from here. I'm pulling from a couple of dozen. So it's the data set's very small. And I'm hoping so the work that I'm doing now, some work with Blueprint Local on redeemable equity, potentially doing some work in the Nordics, and then also here in South Africa. So hoping to have lots more data points on this to going forward. So, definitely Kanini, you'll keep in touch because we'll continue to chat. But I mean, just in general, everyone keep in touch because there's, I think there's a lot more that can be I would say researched here, but it's all about, I would say, just applying it. Okay, I'm going to actually skip through some of these. One more that I definitely wanted to bring up before we go is supply chain and invoice factoring. So this is a company called Equal Exchange that has essentially does something that essentially a pre-purchase, so a form of supply chain financing, which is something that corporates can do. In essence, they can either purchase early or at a discount the goods. So for instance, if you have a startup that has multiple large clients that it is selling to regularly, one way to potentially look at filling some of the working capital gap is to get those clients to either pay early or to pay them a discount, give them a discount, not pay them a discount, give them a discount that encourages them to pay early, which can help solve some of the working capital gap. And it's called supply chain financing. And there actually are multiple organizations out there that can help funders do this. So I think that this is something that it's part of trade finance in essence, which is the oldest form of financing in the world, and something that can be incredibly useful. So the example of the examples in the book around purchase order financing that's in Kenya actually is an organization called Powered by People. And what they do in purchase order financing, let me just walk you through a case because it can sound quite complex. It doesn't need to be as complex as it is. So this, in essence, what happens is that artisans, in this case, artisans in Kenya, often informal or semi-formal artisans, really struggle to be able to have the access to the working capital to be able to complete large orders. So they'll wait for it to be paid from one order to be able to start the next, to be able to buy the goods that they need. And so what purchase order financing does for them, as it does for any organization that's looking for working capital, is it allows them to take an order from a client and borrow against that order. Now, this has been done historically by traditional banks and can be very extractive and with terrible pricing, but it has rarely been applied to very small companies and has not been applied with very attractive financing. So there's a huge opportunity within the impact space to take some of the concepts of purchase order financing and do this well. So that artisan has, say, an order from IKEA for jewelry that they are making. What happens is they place this order for $20,000 with the artisan. The artisan then takes this order from IKEA and gives it or takes it to Powered by People and says, I have this order for $20,000. Will you buy 50% of this order? And Powered by People then buys $10,000 of that order for $9,500. So in essence, that $500 is the cost of this financing. And so that artisan then takes that $9,500, can go away, can do the all of the input, buy all of the materials for the jewelry, etc. When IKEA pays for the goods. So when the artisan delivers the jewelry to the department store, once they pay, the department store pays Powered by People the full $20,000, and then Powered by People pays the artisan the remaining $10,000 that they are owed. So the commission is essentially the upfront payment. Now, as I said, this can be very extractive. It can also be done in a way that's super empowering. So particularly for organizations that are wanting to take on large contracts that are not able to do so, of being able to know that they have a funder that will essentially loan against that large contract can enable them to be able to take on that type of work. And this has been done, at banks forever for large companies, but rarely for small businesses, particularly not for small impact organizations, and not always at appropriate pricing. So there's an opportunity here from an impact perspective to use potentially blended capital to be able to offer this type of relatively low risk. Remember, because you're basically loaning against this company paying. So there is some delivery risk, but mostly it's against a larger company actually paying, larger or medium-sized company paying for the goods. This one is more complex. Questions on purchase order finance. What I would say here is that there's multiple organizations that are popping up, fintechs that are popping up to do this, and some with an impact lens, but many actually across the continent. And so there are significantly more opportunities. One organization that I've worked with in the past, in addition to Powered by People, is finvex.tech. That's also doing this from a supply chain financing and invoice factoring. And these are all in the book and in the examples. Okay, so another option for venture, so mezzanine loans, mezzanine SME loans, or venture finance, kind of often called very similar things. These are opportunities for organizations to access capital that, again, in this quasi-equity, in between debt and equity space. Here's an example of a SME mezzanine loan in the African off-grid energy space. So the Energy Entrepreneurs Growth Fund provides a mezzanine loan for 3 years to a microgrid company. There's a grace period of 1 year. After that time, the microgrid company makes 3% cash interest payments, so quarterly. So they have a cash interest component. They also then have a revenue participation. So we talked about revenue-based financing. So it's both a kind of traditional debt interest component as well as a revenue participation. And then at the end of the 3 years, when the loan is paid off, in this case, it's a bullet payment, so the full principal is due at the end, then the revenue participation ends at the end. So the ability to then marry essentially both a traditional debt loan with a revenue based, and in this case, generally it's unsecured financing. So there may be some assets underpinning it, but generally it is unsecured. Sorry, I see that there's a question in the chat about purchase order. Yeah, Dora, it can. It doesn't, as long as there is a client on the other side that is, or that has a purchase order for an order from the business. It can be service-based or product-based. It hasn't been used as much for service-based businesses, but it absolutely can. For service-based businesses with recurring revenues, revenue-based finance might be a better option, but you could absolutely factor an order that had a service component. So the idea here between with the kind of mezzanine loans is, again, very, very much in this quasi-equity space where you have where a traditional loan, a traditional interest bearing loan would not necessarily have worked for this microgrid company, but being able to do a low interest, fixed interest payment with a potential upside allows the funder to be able to do a more risky investment into this company, but without necessarily having to take equity, because it's not an equity play. And again, Charlotte, these vary. So the question is, are the examples grace period, interest payment, revenue participation typical of all mezzanine loans? No, Charlotte, what I've tried to do in the book is to create some categories of these different types of structures. So for instance, quasi-equity is often referred to as everything, almost everything we've talked about today. And so it's not very descriptive. It just means quasi means in between. So it just literally means in between debt and equity. So the categories that I've tried to create in the book are in some cases, I mean, just I've created them. So the terminology is not necessarily the same that everyone uses. So in some cases, people would use the term, mezzanine loan, and it would be completely revenue participation, or it would just be a mezzanine SME loan that is just on top of the subordinated debt or below the subordinated debt in between equity. So there's not a lot of, I would say there's not a lot of agreement within the space in how those are used, but I think that this is potentially how we should be talking about them. And I see more and more funders kind of using this type of category and even some of this type of language to describe them. But I do say that I would say one of the things that is best practice for mezzanine loans is always to have a grace period. That's something that is consistent. So the last one is something called convertible revenue-based financing, which looks pretty similar to it looks pretty similar to a few different things we talked about, but it looks very similar to a convertible note. In essence, it's an investment, an equity investment, but that is done from a debt perspective that allows the entrepreneur to either go raise funding and then have the debt convert into equity, or be able to repurchase it. So it's somewhere in between a revenue-based financing and a redeemable equity, because the reason I'm calling it convertible revenue-based financing is that unlike redeemable equity, that actually is an equity investment, convertible revenue-based financing is a debt investment. So it sits on the balance sheet as a debt investment and is then repaid as a debt investment. And it can either be through dividends, through free cash flow, or as a top line part as a revenue repayment. And so the example in the book is Maya Mountain Cocoa, which then raised essentially $200,000. They had to repay 2 times. And so they were able to then expand. They had a 2-year grace period. And what ended up actually happening with Maya Mountain Cocoa is they actually ended up raising an equity round. The reason they did this type of financing at the beginning, which is the first example of this type of financing that really had ever been done, and particularly in the impact space, was that they weren't an equity play. So Maya Mountain Cocoa was not planning to be, the next, Nestle. And frankly, they didn't have interest from a lot of equity investors because they were doing farming. Sorry, they weren't doing farming. They were supporting local farmers to do sustainable cocoa, and they didn't necessarily see it being an exponential growth business. And so by being able to access this risk capital that they could repay, it gave them the opportunity to raise capital from investors that were interested in the mission, but didn't need to buy into this idea of exponential growth from this company. What ended up happening is the company was quite successful and then was able to actually work with a group of equity impact investors and then converted the funders into equity holders. So in the future, then they will have some sort of hopefully liquidity event as a traditional equity investor. But for Emily, who runs Maya Mountain Cocoa, at the time that she was raising and she needed this expansion capital, she was in an accelerator, and frankly, none of the VCs were interested because it was just an agricultural company that didn't necessarily have exponential growth potential. So again, these alternatives are about finding the gap and really being able to pick your option. So here's the types of structured exits that we've talked about. So mezzanine debt is a loan that's paid back with fixed interest and potentially some sort of upside, including a profit share. Revenue-based financing is a debt agreement that is a loan that's repaid as a percentage of revenue. Convertible revenue-based financing is also a debt agreement that can be paid back or that can convert into equity down the line. And redeemable equity is an equity agreement that can be redeemed. So I'm just going to go back here again. And as I said, every single one of these slides is a graphic from the book. And also they're available on the website on adventure.finance. I'm just going to go back again. I know we haven't talked about grants, but that wasn't the remit for today. So let's look at the collateral side. So if you don't have physical assets in a credit history, if instead you have some sort of invoices or purchase orders, you can access invoice factoring or purchase order financing or supply chain financing. If you have recurring or repeatable revenue, you may be able to look at revenue-based financing. If you have venture capital funding, you can look at venture debt. If you are planning to repay your investors from internal cash flows, then depending on your growth projections, you can look at convertible revenue-based financing or redeemable equity or some sort of mezzanine debt. All right, so that was a whirlwind. Getting through all of that in an hour is always difficult, but I think the thing that I would just like to leave you all with is that there are a wide variety of options outside of traditional venture capital. We need to be able to, as an impact space, I think, play more in this in between debt and equity to be able to really provide the type of financing that organizations need. And I think it starts with education around what's an option, and then also just is around being able to just put capital out there. You can get my book at the easiest way is to go to adventure.finance. I'll put it in the thing here. And then there's a variety of options there, including Amazon if you need to, or if you're in the States, there's a link to be able to get it from an independent retailer to be able to support a local organization. You can get it online. You can also get it from Palgrave Macmillan, my publisher, although I would suggest if you do that, be very patient. It takes them a long time, but they do ship anywhere in the world for free, including all over Africa. Amazon, if you're able to get Amazon deliveries, does as well. That's all I have for today. Thank you very much. Hope you guys are enjoying SunCalc, and I look forward to seeing so many of you in person someday soon. So many familiar, wonderful faces that I would love to sit and hang out with in person. But have a great rest of your day and enjoy the rest of the sessions.